It's a great visual. Exhibit 9.6 illustrates it. Companies, especially large ones, are constantly facing the challenge of replacing the revenue from maturing or declining products with new products or services that are just as big.
Like running just to stand still.
Exactly. The pharma industry is the classic example. A blockbuster drug goes off patent, and you need another blockbuster just to fill the hole, let alone grow overall revenue.
And finding those big new growth engines is hard.
Very hard. It often requires significant long-term investment and patience. The book mentions Royal Philips taking something like 15 years to fully pivot its business towards health technology. That's a long horizon.
Wow. 15 years.
And the long-term data on company growth is quite sobering, too. Exhibit 9.7, looking at non-financial companies from 1965 to 2017.
What does it show?
It showed that in almost every year, at least a quarter of companies actually shrank in real terms. Sustained high growth is the exception, not the rule, especially for larger, more mature companies.
A good reality check for anyone building financial forecasts. Don't just assume strong growth continues forever.
Absolutely. Be realistic, especially about that long-term growth rate.
Okay, so let's get into the actual valuation methods. The book highlights two main ones.
Primarily, yes. Enterprise discounted cash flow, or DCF, is probably the most widely used. And the other is discounted economic profit.
And they give the same answer.
If applied correctly, yes, they should mathematically reconcile, but they offer different perspectives.
How so?
DCF focuses directly on the cash flows the business is expected to generate, which is very intuitive. Economic profit links more directly to economic theory. It explicitly calculates whether the company is earning more than its cost of capital each year.
Showing the value creation year by year.
Exactly. It makes the link between ROIC, growth, and value creation very clear. The book actually recommends using both methods as a cross-check.
Okay, and there's a variation for companies with changing debt levels, APV.
Right, adjusted present value. It's useful when you expect the company's debt-to-value ratio to change significantly over the forecast period. You value the company as if it were all equity financed, and then separately add the present value of the tax savings from debt.
Got it. Now, all these methods rely on forecasting the future. What's the key to building a good forecast?
It really starts with a deep dive into the company's past performance and understanding the trends in its industry and the broader economy.
History and context.
Absolutely. You use that to project the key value drivers: revenue growth, ROIC, and ultimately free cash flow. The goal is to build integrated financial statements, income statement, balance sheet, cash flow statement, where everything flows logically. Exhibits 10.5 and 10.6 show examples. Chapter 13 goes into the mechanics.
And once you have the total value of the business, the enterprise value,
Yeah.
how do you get down to the value per share for stockholders?
You take that enterprise value and subtract the market value of any claims that have priority over common equity. The big one is usually debt.
Okay, enterprise value minus debt.
And potentially other things like preferred stock or pension underfunding. What's left is the total value of the common equity. Exhibit 10.4 shows this. Then, you divide that total equity value by the number of basic or undiluted shares outstanding.
Why undiluted? What about options and convertible debt?
You need to account for those, but the book recommends valuing them separately, which can be complex, and subtracting their value from the total equity value before dividing by the basic share count. Dividing by diluted shares can lead to double counting.
Okay. Clear distinction. Let's revisit economic profit. How exactly does it show value creation?
Economic profit for a year is calculated as the invested capital at the start of the year, multiplied by the spread between ROIC and WACC for that year.
So capital times ROIC minus WACC.
Exactly. If ROIC is greater than WACC, the company generates positive economic profit, meaning it created value that year. If ROIC is less than WACC, it destroyed value. The total value of the company is then the invested capital plus the present value of all future expected economic profits.
That really spells out the value creation link.
It does. While FCF combines ROIC and growth implicitly, economic profit makes the value creation explicit.
Now, to calculate ROIC and economic profit accurately, you need a good measure of invested capital. How is that defined?
There are two main ways to look at it, which should reconcile. From the asset side of the balance sheet, it's operating assets minus operating liabilities.
Things needed to run the core business.
Right. From the financing side, it's the sum of all investor capital, typically common equity, debt, and any debt equivalents like capitalized operating leases or pension deficits. Exhibit 11.1 lays this out. You have to be careful to distinguish operating items from non-operating items like excess cash or financial investments.
And NOPAT, net operating profit after taxes. How do we adjust the income statement for that?
Two key adjustments. First, you calculate operating profit before deducting interest expense, because interest is a financing cost, not an operating cost. NOPAT should reflect the profit generated by the operations regardless of how they're financed.
Makes sense. And the second?
You exclude any income or losses from non-operating assets. If you excluded those assets from invested capital, you also need to exclude their income from NOPAT to get a consistent measure of operating return.
Isolate the core operating performance. The book uses Costco as a case study for this, right?
Yes, Appendix H has a detailed Costco valuation, and Chapter 11 uses examples from it too. Exhibits 11.4 and 11.5 show how you'd reorganize Costco's balance sheet to calculate invested capital line by line, deciding what's operating, like inventory, PP&E, operating cash, deferred membership fees, and what's not.
And taxes and NOPAT, how are they handled?
Getting a perfect measure of cash taxes paid just on operations can be tough. The book often uses operating taxes from the adjusted income statement. Exhibit 11.11 shows how to reconcile reported income taxes to operating taxes, adjusting for taxes related to non-operating items or interest expense. Sometimes, like in the Costco example, an average tax rate might be used for forecasting if historical rates fluctuate.
What about things like operating leases and pensions? They complicate the balance sheet.
They do. For operating leases, accounting rules now require capitalizing them, treating them like debt. The book notes that while this improves comparability between companies, it doesn't change the intrinsic value if you consistently account for the lease payments and free cash flow and the lease liability as debt when calculating WACC and enterprise value. Chapter 22 covers this.
So consistency is key. And pensions.
Pension shortfalls are generally treated as a debt equivalent, another claim on the company's value. Excess pension assets, if any, are treated as non-operating assets. Both should be valued separately from the core operations.
Okay, moving into forecasting details. Revenue growth decomposition. Why is that important?
Because not all revenue growth is created equal. Exhibit 12.7 uses examples like Compass and Sodexo to show how you can break down reported growth into underlying organic growth. More volume, better pricing, the impact of acquisitions or divestitures, currency fluctuations, and even one-off things like having an extra week in the fiscal year.
Understanding the quality of the growth.
Exactly. Is it sustainable organic growth or just buying revenue through acquisitions? That distinction is crucial for forecasting.
And when forecasting the full financials, revenue is usually the starting point.
Typically, yes. It's often the main driver. Exhibit 13.4 shows an example forecast where you project revenue growth and then forecast other items like cost of goods sold or SG&A as a percentage of that revenue based on historical analysis and future expectations. Depreciation might be linked to property, plant, and equipment, PP&E.
What about forecasting acquisitions? Many companies grow that way.
Given the often poor track record of acquisitions actually creating value for the acquirer, the book recommends a conservative approach.
Which is?
Assume zero growth from future unplanned acquisitions and hold goodwill and acquired intangibles constant. Essentially assume future deals will only break even in value terms. It avoids baking in overly optimistic synergy assumptions.
A prudent baseline. Once you forecast the income statement and assets, how do you ensure the balance sheet actually balances it?
Good question. You need a plug. Exhibit 13.13 explains this. You forecast most balance sheet items based on your operating assumptions. Then you hold certain financing items like debt and common stock constant initially. The difference between the forecasted assets and the forecasted liabilities plus equity becomes the plug, often excess cash, or maybe additional debt needed, or sometimes changes in equity via retained earnings. This ensures assets, liabilities plus equity.
Got it, the balancing item. Inflation is another forecasting challenge. How do you estimate expected inflation?
The bond market gives good clues. The yield on a standard government bond includes both a real interest rate and the market's expectation of future inflation.
Nominal rate, inflated rate plus expected inflation.
Exactly. And you can get a good estimate of the real rate by looking at inflation-linked bonds like TIPS in the U.S. The difference between the nominal treasury yield and the TIPS yield for the same maturity gives you the market's implied inflation expectation. The book shows an example using 2019 rates.
Clever. Now, the tail end of the forecast, the continuing value.
Right.
It's often a huge part of the total value. How do you estimate it properly?
Yeah, it's critical to get it right. The book strongly warns against simplistic approaches, like just slapping the current PE multiple on the final year's earnings.
Why is that bad?
Because the company's growth prospects and ROIC at the end of the forecast period might be very different from today's. The continuing value calculation needs to be consistent with the assumptions about the company's performance in that future steady